Host Josh Appleman, founder and CEO of Appleman Properties. Today we're joined with Shawn Griffith. Shawn has extensive experience in multifamily investing and as a limited partner, as a GP side as well as a key principal. Is currently in a GP in 303 units and passive investor in 3,366 units. So the name of the show is Passive Investing is a Lie, and I can say Shawn certainly sounds like he qualifies. But Shawn, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, absolutely, Josh. Thanks for inviting me on the show and giving me an opportunity to chat about one of my favorite subjects, which is real estate. And the map up behind you there reminds me that my other favorite thing is travel.
Yeah.
And I'm actually working on a book that's going to combine the two. How can you use real estate investing to fund your travel habits when you retire? But we can get into that later. A little bit about me. My wife and I started investing in real estate about a dozen or so years ago. And I'm trying very hard to get rid of the term passive investor. And we'll talk about that in a little bit. We invested in our first deal as a limited partner, and we just were absolutely spoiled. It was one of those sweetheart deals that we made like 3.5 times our money. It cash flowed 12 to 14%. And, it was just a home run. I'm still looking for another deal that good after a dozen or so years.
Yeah.
Haven't found one yet, but still looking. And, fast forward to November of 2020, and my wife and I were sitting around the kitchen table talking about our finances and what things were going to look like in retirement. And, excuse me, we came to the realization that the bill of goods that Wall Street and corporate America had sold us wasn't quite all it was cracked up to be. I mean, don't get me wrong. We had money in a 401k and we'd have had an okay retirement, but, we'd have to cut back on our standard of living and what we give to our church and charities and cut back on our travel. We didn't want to cut back on anything. We wanted to step it up a notch. And we asked ourselves the question, well, how can we do that? And we looked at several different opportunities. And for us, the answer was syndicating real estate. So we found a coach and mentor, dove in head first, and really, got our first property under contract and closed on it in November of 21. And I've been fortunate that that's been my best performing property to date. We just did a distribution a couple of weeks ago. And, it's definitely a learning experience. But that's kind of the nickel tour of me and what I did and how I got into real estate. But if you want me to talk a little bit more about why passive investing is a lie, I'm happy to do that as well.
Yeah, we're certainly going to get into that because I wholeheartedly agree with you because it's there's two sides of that. But on the one that you had purchased in 21 and just sent out a distribution, I'm assuming that was a heavy value add.
Not really. Okay. We put maybe, I don't know, a couple of $100K into it total. And we haven't done any significant upgrades to the units. There were still a few units that hadn't been brought up to the new standard. So we, as those turned, we brought them up. We still have one unit that probably will never get updated because the guy that's in the unit's been there for 30 years and he doesn't want to move. And, he doesn't want people coming in and moving his stuff. And so cool, I'd love to have more tenants like him.
Yeah, you have to flex into really anything in life. Different scenarios come up and adapt, flex, and it's don't be the stick in the mud. Let's talk about you investing in over 3,366 units as a passive investor. Let's talk about the first. Well, you talked about the first one, and then the second. Let's get into the second one, and then what really made you accumulate so many units as a passive investor.
So the first one really spoiled us and opened our eyes to what's possible with real estate. Have they all been that good? No. And one of the lessons that I learned, it wasn't on the second one. The second one did okay. It performed as advertised. But this was during that time when if you could fog a mirror, you could make money in real estate. You didn't have to do anything special. You could have a few hiccups here and there, and you still hit your projections. Those same operators today would probably have failed and given their property back to the bank. So for me, the big thing is not only do you need to learn enough about underwriting, you don't have to be an expert. You don't need to go find properties. But if you're a passive investor, and again, don't like that term, if you're a limited partner on a deal, then you need to know enough about the underwriting so you can at least read somebody else's underwriting and look at it and understand what all these numbers on these spreadsheets mean. And the numbers really fall into two categories. They're either facts, things that you know, like the number of units, the square footage, the price per unit that they're getting right now. And then everything else is an assumption, things that you think you know, or you can make an educated guess about, like, what can I raise the rent to, in 3, 6, 9, 12 months down the road? What are the expenses projected down the road? And so, like insurance, nobody knew insurance was going to double. You can't underwrite for that. You can allow some flexibility in your underwriting by, overestimating costs and underestimating, income growth. And that gives you a little more flexibility. Everybody tries to push everything right up to that edge. And, as an investor, this is where I get into you as an investor should not be passive. The income can be passive, but you as an investor need to do your homework, and not just on the property, on the team. You need to ask hard questions because you're investing your money, your hard-earned capital. Potentially you're risking your retirement based on this person that invited you into a deal. And if you don't know them really well, and you don't know, at least have some comfort level that the team is all on the same page, your money's at more risk. And the reason I say that, on my third deal we got into, it was a guy that we got into on our second deal that did well. He had another deal. We got into that. And turns out I really didn't know the other 4 partners on the deal. So there were 5 partners on this deal. And I just assumed he had done his homework and vetted the partners, and that they were all on the same page as how the property was going to be run. Well, that wasn't the case. There were 5 different opinions on how the property was to be run. The property management company got 5 different directions, all of them conflicting. And so they basically fell to the lowest level of service required by their contract, which, as we know, is not anywhere near enough to make a property operate well. Now, the only saving grace was this was during a time when you, like I said earlier, you can fog a mirror, you could make money in real estate. We still made some money. It was not the doubling our money that they had promised. We never saw a penny of cash flow in the 2.5 years we were invested in that property. And, I was happy that we got out with our money plus a little bit. And then we found another deal that we liked and put it into that. But, one of the things you have to expect going into this, and you as a prudent investor should plan for, not every deal is going to perform as advertised. I've been invested in enough deals now to know that, even if you've got operators that have proven track records, even they run up against things where stuff just happens, right? I mean, and you have to deal with it. I've got a guy that we've invested with in several properties. One of them is doing great. And one of the properties, I think they did 1 distribution, and then they had to stop distributions because they had an insurance claim, and they're still in litigation with the insurance company to get them to pay off. And so,
Wow.
It's a business. Things happen in business. You try to build as much flexibility into your plan, as a general partner that you can. But again, it kind of goes back to, you as an investor. If you're a limited partner in a deal, I like to focus on the partner part of that. Yeah, it's limited in the terms in that, we're not expecting you to show up and do work and visit the property and things like that. But there's still a partner piece in there. And you need to do your part as the investor so that you're comfortable with the deal, so that you understand what the plan is, so you understand that there could be potential risks to your money. And that's another subject that I love to talk about is, do you as an investor understand your risk tolerances?
Yeah.
Anyway, I could go
Yeah.
on about this for days.
You're hitting spot on everything, and I want it to be where people just absorb it, because you've taken years of experience and you're condensing it down to biteable pieces. So that's huge. I have a question on you've got 3,000 units on the back end. Even reviewing the financials that are coming in, do you have a team behind you to make sure, an asset management team just managing the 3,000 plus units?
So for the deals that we are limited partners in, we do try to review the financials. Our youngest son works for us and does part of that. Fortunately, he's smart like his mother, and my wife has an MBA in finance, and is very good with with that kind of stuff. And she can breeze through financials way quicker than I can. I understand them to a certain degree. I'm learning. It's like everything else. And one of the things I love about this business is there's something to learn every day.
Yeah.
But so we do try to look at those, not necessarily on a quarterly basis. If the property's running well, and they're doing distributions, honestly, I'm not going to pay quite as much attention to them as I am the ones that may be having issues or they're not doing distributions. Mostly from the standpoint of now that I've got some general partner experience, I might be able to offer a solution, or at least throw an idea out there and say, hey, I've seen this on my property. So prime example, one of the things we've seen on a lot of properties across the DFW Metroplex is there's been about a 70% increase in the number of falsified employment documents being submitted on applications for rental.
Wow.
70%. I mean, that's
What's
crazy.
the cause behind that, do we think?
Well, I think a lot of people, either their salary hasn't kept up with inflation, and they're trying to pad their employment numbers, because most places require you to make 2.5 to 3 times your rent in salary, and some people just don't qualify for that.
Yeah.
And and we've along with the rising expenses and things that we've had, people are paying more for groceries. I don't care what the numbers that get reported out of Washington are. If you want to understand real inflation, go back and look at the price you paid for a loaf of bread over the last 5 years.
Yeah. Yeah. It's being hit everywhere. I mean, you can feel it for sure. And people want shelter. In order to get the shelter that they literally need, they need to pad numbers, and hopefully they get through, and then that can lead to other problems. And we know what that looks like too.
Yeah.
You're a true GP now. You're managing deals, and are you all relying on third-party property management, or are you managing the properties on your own?
Oh, third party all the way.
Okay.
I've seen my first property. We hired the property management company that was already in place because they were doing a great job, and I interviewed several others, and all things being equal, I thought, you know what? These guys are already there. It's going to be less hassle for the tenants. It's going to be less hassle for the guys taking over because they're already there. And, and the regional had like 30 years experience in the industry. She had managed like every property, within like a 50-mile radius for at some point during her career, or pretty close to it. And, it was a great deal. Yeah. Unfortunately, 3 months after we took ownership, she decided it was a good time to retire. And her replacement lasted about 2 months. And then her replacement lasted about 3 months. And then they finally brought in their troubleshooter, because by then my occupancy was down to like 78, 79%. And while she was getting it turned around, I didn't feel comfortable that they, had the ability to keep good people in the office. So we ended up doing a change, and the guys that we went with have just knocked it out of the park. They went from, 80% occupancy up to 94% in 6 weeks. They've all been quality tenants. And they've got our collections the highest they've ever been. So yeah, I firmly believe in third-party management, but like anything else, you have to look at that as a division of your company, and you have to manage it accordingly.
Yeah, it sounds like you all hit the home run though. Finding that management company that is performing as well as you all have found them to perform, that's an anomaly. Unfortunately, it is, because
I agree.
With the how hot, I'm going to say how hot real estate became multifamily specifically, that created it, and the problem with finding good people to run and actually to show up for work and actually work in position. It's created a shortage of good people, and property management is a very hands-on. It's very it's not glamorous, but it's got to get done, and finding the good
well
people.
You've got to find people that have that heart to do that.
Yeah.
And they've got to be people. And the other thing is, I like to tell my partners when they, when I make a mention that, hey, we need to boost our payroll at this property, everybody finds a reason to cut payroll, right? Well, that property manager that has their butt in the seat every day at your property is the key to having a well-run property and managing your multi-million-dollar enterprise, and you're paying them crap. One of the things I got a great compliment. We had a broker that did a BOV on that property, our first one, and came back and said, your financials look textbook. He goes, you're running a really, tight operation. I don't see very much in the way of, giving you advice or suggesting improvements. He goes, the only comment I would make is that your payroll looks a little higher than average. And I'm going, yeah, because I have good people and I want to keep them.
Yeah.
And, it's like any industry. I mean, if you want to keep good people, you got to pay them, especially maintenance people, because they are hard to find these days.
Yeah. It's even better when you can align their pay with performance. The way the property does better, everyone does better, just like a business in a sense.
Yeah.
If they have certain metrics that they're accountable for, and they're able to take ownership on those pieces, and it runs well, it runs like it should, they should absolutely feel the wealth. It's just a part of it. Everyone, you've got those people.
I couldn't agree more. I know when I used to work at Southwest Airlines, they have profit sharing. And, when somebody would bring up something in a meeting that didn't really, follow company goals or procedures, or, was, contrary, might cause us drop in profit, I was not bashful at all standing up and going, well, how is this going to affect our profit sharing plan? And, people learned very quickly that, if they were going to say anything controversial, if I was in a meeting, that phrase was probably going to come out. But yeah, absolutely. Some sort of profit sharing or bonus incentive is, that's a crucial part of our property management.
Yeah, for sure. And that is truly the bloodline of a successful operation is, in this case, property management and real estate, but operations in general. You get sales and marketing, operations, and finance. Those are the three key buckets to any operation, and dividing into those into functions, to be able to tally them out to the right people is huge. The 3,000 plus passive investing units. So were these 3 to 5 year hold times? Were they?
So going in, it was kind of that standard, everybody said 3 to 5 year hold. Most of them were around 4 to 5 years. And like I said, we had that one that turned out to be a problem property. They sold it in 2.5 years, mostly because the partners couldn't agree on anything. And that's why one of the questions I always ask general partners, because I still do some passive investing myself, because my wife and I eventually want to get to the point where we have enough cash flow out of property and enough properties that are turning over that we can pull proceeds out and live off that in retirement. I'm getting
You should be
close.
doing that with 3,000 plus units. Like that should already be accomplished, I feel like.
Well, unfortunately, probably half of those aren't cash flowing right now.
That's wild.
Or if they are, they're not cash flowing as projected. So, and again, that's one of those things where, you've got to, you as an investor, this is where that non-passive part of being a passive investor comes in, that being a limited partner. You need to look at your plan, your investing plan, and go, I'm a big advocate. Don't invest everything in the stock market. Don't invest everything in real estate, and don't invest everything in real estate with one general partner. You need to spread your risk around. And I've had this conversation with investors. I'd go, hey, Josh, yeah, I would love to have you invest all of your money just with me, because that would be awesome. But that doesn't make sense for you as the investor, because that increases your risk. Because if something happens to me, what's going to happen with your investment? Now, I always partner with people. I always make sure that my partners know what's going on. And we kind of have a high level succession plan in place, so that if something happens to one of the partners, somebody else can step in and take over.
Yeah, that's huge. That is absolutely huge. We've got the what if I die scenario too.
Yeah, you got to ask those questions.
Yeah, because the show still needs to go on with or without you. You've got a lot of people that are relying on you to show up, but if you can't, something happens, then what happens there?
I tell my investors, I said, if you want to be blunt, just ask, well, Josh, if I invest with you and you die, what happens to my money?
Yeah.
And most GPs will kind of go, because they've never had anybody ask them that question.
Yeah. Well, and
you can be a little more subtle and say, well, what if you win the lottery and decide to move to Haiti and nobody ever hears from you again? What happens to my money?
Yeah. Yeah, no, and that goes back to team. If you vet and verify the team, that they're a true operation, they're not just some stand-up, fly-by-night people who got together one night and decided to syndicate, then, and what is their background check? Are they willing to show their balance sheet to show that they can actually keep the property going with if the property doesn't perform? I mean, I would want, if I'm investing, I want to see the GP's balance sheet. I want to see what they actually have in the bank. I don't care about how much they're putting into the deal. If they're personally guaranteeing it and they're running it and they're finding it, the jockey on a horse, I don't care about how much they're putting into the deal, but I want to know that they've got enough in their balance sheet to support the size of the deal, to make sure that it makes sense. There's a balance. You don't take down a $200 million apartment complex or property or whatever it may be, and you have nothing. You don't have a balance sheet.
You got $1,000 in the bank, and I mean that's a spit in the ocean right there.
Right, and you just round up 4 KPs to take. It just doesn't balance the experience. It just doesn't work out like that. And unfortunately, I think the past 3 years there's been quite a bit of that. There's been a lot of people getting into the industry without any kind of business acumen or business experience. They bought based on pro forma. And they put way too much money on the deal on top of the purchase price, whether it's acquisition fees or overinflated, bloated CapEx budgets, or they've got the wrong property management on it. They don't know how to operate the property themselves. There's so many different
or worse, all of the above,
or all the above, and it's just a conglomeration of a lot of money at risk that people are going to lose because of true ignorance, and people just got they got the shiny object syndrome, and they wanted to go take down a big project, and got a lot of people that believed in them ultimately. And that's just there's changes out there happening right now, especially with interest rates and the way that the market is right now. It's either a really good opportunity to buy for a lot of people, or it's really bad times for a lot of people. Unfortunately, it's one or the other. We've always bought on conservative notions that if it doesn't cash flow today, then it's a business. Then it's move on, find the next deal, and hopefully it does.
Yeah,
got to the point where you couldn't find anything unless it was off market and it was a unicorn deal. But
we've got a property, the one that we just closed on Friday. We told our investors up front, because it's a very heavy value add. It's the biggest value add property we've taken on. We're going to be putting probably $2.5 to $3 million into this property. And there's crews on site today starting work. I mean, it's a lot of work to be done.
Yeah.
And it's like 70% occupied. So it's not cash flowing today. And normally I would agree with you. You don't want to buy something that's not going to cash flow from day one unless you build that into your model and you understand and you capitalize it well enough to know that, hey, the first, 9 months to possibly 12 months, you as an investors aren't going to see cash flow that first year. Most of those investors are investing for the long haul anyway and don't need the cash flow. Now, we all love cash flow. Don't get me wrong. I wished it. And typically we try to under promise and over deliver. So, our goal is to get cash flow sooner than what we told investors. And a lot of that's going to be with our property management company, which we have a strategic relationship with the property management we're using now. And, it's going to be really interesting on this one.
Well, if the numbers prove themselves out and it's in an area that makes sense, and to me, management's everything. Management, every property we bought we bought it based on it was failing because of management. That was the only reason. They just didn't know either how to manage the financials or didn't know how to manage the property. But that's the secret sauce. You get in there with a true grit mentality,
or you have a management company that just gouges you on fees and every little thing. It can get to be ridiculous, and that's why you've got to, as a general partner, you've got to understand the financials well enough to look at it and go, oh, why are you putting this here? This should be under the line. Or, why are you charging me this? That should be part of your management fee, So you just have to keep, again, sometimes that's intentional. Most of the times I would say it's just how they normally do business, and you just have to call them on it.
Yeah, totally agree. And that goes into even splits on the deal too. I'm a believer in 50-50. If we find a deal, we're personally guaranteeing the deal. We're executing on the business plan, and making the renovations and procuring the labor, procuring the material, just taking care of everything as a whole. You're going to see that when it comes to splits as well. Versus other syndication firms that might be doing 70-30, and that's okay too, but they're not necessarily, in your all's case, you've got third-party property management, which is an extension of yourself. And they're taking care of it. There could be rationale to where some things might be offset by others, depending on how the thing is structured as well.
Yeah. Typically our deals, we do an 80-20 split. 80% goes to our limited partners. 20% goes to the general partners.
That's generous. That is very generous.
Well, we want repeat investors.
Yeah.
We may change that in the future. I don't know. But it's working for us right now. And as long as it continues to work, we'll probably leave it that way.
Real estate is slow. These things take years to turn around, and it's a major process, and it absorbs so much time, effort, and energy to do it the right way. And at the end, I just want to make sure that it's been well worth our time. And every property's got different arrangements, different needs, wants. Because you can also you can velocitize your time by putting property management in front of you as well. We self-manage all of our properties in-house, so that and we are in the thick of it. We're in the weeds. We also control it. So there's different things, but there's different operators that require different models, and it works.
Yeah, we've got some friends in San Antonio, a couple of different groups that are they're completely vertically integrated. They have all their property management in-house. They have their construction in-house, and that works well for them. We may do that at some point in the future, but right now we're going, we do well with third-party management.
Yeah. It sounds like you all have a rock star property management company to work with.
Yes. We actually two of them. One of them generally doesn't work with general partners because they have, I think they've got 10,000 units under management, and they own 6,000 of them.
Yeah.
The other 4,000, they do as a courtesy for some customers that they deal with that are like small and mid-sized family offices.
And they'll probably own those properties sooner or later. It might be a strategic move, get them under management, and then when they're ready to sell, the buyer's already managing it.
Right.
Yeah. Yeah, no, that works. That's awesome. On the passive investing front, so you went to the flip side of being a passive investor. Now you're on the GP role. You're in the thick of it. So what would be some advice that you could give somebody out there that's listening that is either in a passive investment deal or is looking to get into passive investing?
Well, if they're looking to get into passive investing, if they've never done it before, I would say educate yourself. That's the first thing. Learn a little bit, and then find somebody that you trust. Obviously, you need to get to know them, and at some point you're going to have to take a leap of faith, because you will. I trust me, you will never know everything there is to know about real estate investing, ever. I've got a neighbor down the street that's been in real estate for 30 plus years. He mostly does 1031 exchanges. And I took him to the club one day to pick his brain about 1031s. He ended up asking me questions about syndication because he hadn't even heard of syndication. And he'd been in real estate investing for 30 years. So, there's a lot of people out there that have never heard of syndication or crowdfunding, as it's maybe more commonly known as. I just posted a LinkedIn newsletter article this morning about, if you don't know about an investment asset, you can't invest in it. And I think that's part of why Wall Street and, big finance doesn't want us to know, and they don't make these investments available easily. Because now you'll be able to get ahead and you really won't need them as much.
Yeah.
I mean, I still have some money invested in the stock market. It's not much. Most of my money's in real estate or oil and gas. I'm getting ready to start an income fund that, we'll have some money in that as well. But you've got to spread your money around according to some kind of plan. So educate yourself, find out about your risk tolerances, learn what you're comfortable with. I'm not advocating, go sell all your stocks and put it in oil and gas today. That would be crazy. Maybe you put like 2 or 3% of it in oil and gas, or, and then you put, 10% of it in real estate to start with. I mean, you as the investor have got to do your homework. That's why I don't like that. That's why I say passive investing is a lie. Yeah. Because you can't be passive and do it properly. Now, after you've done all your homework and you invest your money with, say, Josh or myself or some other general partner, now you can afford to be a little more passive, but you still need to keep track of the investment and make sure that we're all delivering on what we told you we were going to deliver on.
Yeah, I think it boils down to doing your diligence and vetting and verifying and making sure that the people behind the scenes are who they say they are and can do what they say they can do.
Yeah, do your homework.
Do your homework. That's it. Very cool. If somebody wants to reach out to you, Shawn, how can they get a hold of you?
The easiest way is just go to my website. It's twtmultifamily.com. And there's a book a call on there, or schedule a chat, reach out to me. As you can already tell, if you've listened to the podcast to this point, I can talk about real estate all day long. I'm happy to have conversations. I have a big passion for educating investors. I don't want people, I don't want to be that guy that takes, the last dollar out of somebody's emergency fund just to get them into a real estate deal. You need to be prudent as an investor. You can take some risks with some of your money. Don't go throw it all into real estate. Don't go throw it all into oil and gas, and don't go throw it all into the stock market. I mean, if you have a big 401k, good for you, but you know what that is? That's a big future tax problem.
Yeah. Unfortunately, that's the truth. Yep, for sure. Shawn, I appreciate you coming on the show today. Definitely look forward to following you and keeping up with your all's growth. For sure. We will certainly talk soon. And again, we appreciate it.
Well, Josh, I really appreciate you sharing your Real Estate Hustlers podcast audience with me. And again, I mean, I love what you guys are doing. So, keep up the great work.
Appreciate it, Shawn. We'll talk soon. Thank you.